Welcome back, everyone. We have a lot to jump into in this episode. We have some economic news. A report from the Wall Street Journal says that households boosted their spending in April, but just recently they're starting to draw more heavily on savings, meaning that people's increased wages have not kept up with their spending. We also have some positive news on inflation. The Personal Consumption Expenditures Price Index, which is one of the measures that the Fed looks at for inflation, came in at 4.9% in April. Now that's down from where it was in March, so we'll look at what that news means as well. And then we also have an update on one of the biggest holdings in my portfolio, one of my favorite companies ever, which is Costco. They just reported their earnings yesterday. I had time to look over it. Costco once again illustrates why it's different than the rest of the pack. Now let's go ahead and jump right in. Let's quickly do a portfolio update to start. This is the passive income account. For those of you new, it is a real portfolio, real money. This isn't like paper trading or anything. We're dealing with real cash here. And this is my most sizable, largest portfolio that I manage. It is a dividend growth portfolio, meaning that I focus on companies that every single one of them is free cash flow positive. These are companies that make money. They make real products, they sell real services, and they make real money above their cost of running the business. So none of these companies are zombie corporations that rely on debt or dilution to fund their operations. Every one of them are strong businesses with good moats and high amounts of free cash flow. I built a tool to track the momentum of different companies and to see if different companies are in a dip, meaning the price is traded down dramatically for these companies over the past 200 days. You can see the price versus the 200-day simple moving average. Almost every single company in my portfolio is in a decent dip, 10% or more. Vici is the only company that's actually above its 200-day moving average. So while Vici has held up really well, it's far outperforming the market. It's actually in the green over the past 7 months, not way down like the S&P 500 or the QQQ. The rest of my portfolio, every single holding, hasn't held up as well. But as a long-term investor and a patient investor, these type of dips should be looked at as opportunities. Some of my favorite companies are now on big sales. Starbucks is down 40% from its all-time high. Texas Roadhouse is down 24% from its all-time high, and Domino's Pizza is down 35% from its all-time high. And aside from all of these companies being on a pretty decent dip, I think that overall, looking at all the valuation metrics, they still remain heavily discounted in this market. Now, one of the companies that's been beaten up because of the results of other inferior retailers is Costco. This is one of the largest holdings in my portfolio, and it's a company that you could say I like a little bit. I've called the company the best company in the world. I've made multiple videos on its business model. I've tried to explain in detail why it's so distinct and different from different retailers, explaining that Costco is a buyer on behalf of their members. They're not a seller selling goods to people like Walmart or Target. They run a completely different operation, and I think that the company should be treated differently. Now, Costco year to date has had an interesting performance. As of right now, year to date, it's down $100 in price. So the company started off trading around $500, then it traded down a little bit. I bought the dip right here around $480. That was when I was purchasing the company. It traded up into the 600s, which I thought was a little expensive even for Costco. We're talking about a forward PE ratio of 43. That's just expensive. No matter what company it is, that's a pretty expensive price. But Costco's not a company that I really like to trade all that often, so I decided to just hold on to the stock. And it started to veer down a little bit. In fact, it traded back down to around $500 per share, and then Walmart and Target reported their quarterly results, which were terrible. Walmart's were bad, Target's were even worse. They didn't manage their inventory well, they didn't forecast well, their margins were crushed, their free cash flow was non-existent, and that caused everyone to become very concerned about retailers in general. Costco sold off dramatically after this happened, in sympathy of these other companies. Now it's bounced back up a little bit to $460 per share, and they just recently reported their quarterly results. Now let's go ahead and dive into Costco's quarterly report. So this came out May 26, which was yesterday, and I made some notations on it. Now, I hope you can read my writing here. If not, I'll start to type it out. But I want to highlight why I think Costco is such a different company and shouldn't be grouped in with Target and Walmart and even Amazon. It's just a very different company with a very distinct business model that leads to much better results over time. If we look at this, we can see clearly the differences in the results. We can look at the overall same-store sales. The same-store sales for Costco in the US were 16.6%. 16%. For Walmart, for example, same-store sales grew by 3%. Costco, 16%. In Canada, it was 15%. In international, it was 5.7%. Overall, that's a same-store sales growth of 14.9%. That is incredibly fast. And this still didn't meet analyst expectations. They wanted even higher same-store sales growth. But if you look at this as a long-term investing perspective, that means that shoppers continue to spend more of their wallet at Costco than other retailers. I think that Costco is consolidating physical retail, meaning I think that they're taking wallet share. They're taking people's money out of Home Depot, out of Lowe's, out of Target, out of Walmart, out of Kroger's, and a bigger and bigger portions being spent at Costco. Having 14.9% same-store sales is incredibly fast. Even on the adjusted basis, when you exclude gasoline prices and foreign exchange, 10.8% is still far and away above any other retailer. The next thing that we can look at is the e-commerce growth. I have a notation here, fast e-commerce growth. That's kind of an understatement. They grew their e-commerce by 7.4%. With just in nominal numbers, that seems kind of slow, but keep in mind, this is supposedly the time of the online retail apocalypse. This is the e-commerce apocalypse. Costco grew their online retail by 7.4%, while Walmart grew theirs by 1%. So 1% versus 7.4%. Amazon grew theirs by -3%. So Amazon's pulled back ever so slightly. Now, Amazon's total revenue still grew because they have a bunch of other things are growing, but in online retail, they had a little bit of a pullback. We have Target that grew theirs by 3.2%. None of them grew nearly as fast, not even half as fast as Costco. And the amazing thing here is that Costco really hasn't put a ton of effort, I believe, into optimizing the e-commerce. The website could use a lot of work. The app could use a lot of work. There's many improvements they could do to optimize this further. So they're growing their online business this quickly without it even being fully optimized. So overall, in terms of same-store sales growth, you have fast e-commerce growth and you have fast same-store sales growth. Everything across the board, in my opinion, looks very good here. Now, moving on, we get down to the income statement. This reveals the profitability of the company, how much money they're earning on an incremental basis. And Costco's a company that has very good cost control, meaning they're not a company that just hires random people that don't do anything. They don't have a bunch of administrators sitting around in a big corporate office. They don't have lots of developers and high-end employees that are very expensive. Costco can keep their costs under control. And you can see this by their revenue growth, their membership growth, compared to their operating expenses. Their membership growth, for example, highlighted here in blue, grew by 9.2%. So that's not the amount of members, but that's the amount of revenue from membership. And this is their profit. This 9.2% is just subscription income. So Costco has a SaaS-like business. They're selling warehouses as a service to some extent. You have to be a member to get in the warehouse and shop there, and that's really where they earn the majority of their money. They grew the membership by 9.2%. They grew their overall revenue, their net sales, by 16%, and their operating expenses right here. The incremental increase to run the business with general and administrative expense went up 6%. So you can see how the actual profitability, the membership, the revenue growth are actually outpacing their operating expenses. That's what you want to see with a mature company that has their costs under control. They have good unit economics, and they're becoming more and more profitable with higher margins over time. I really like these numbers across the board. I like seeing the company grow by 16%. I think that's very fast, given the tough comparables that they had. I like seeing the membership revenue grow by 9.2%. I also think that's really good growth, considering that Costco rarely does price increases on their membership. I think they could increase their prices quite a bit, but Costco doesn't do that. They like to keep their members very happy and make sure they feel like they're getting an incredibly good value proposition. And they're always becoming more profitable. Last quarter, on a diluted basis, their earnings per share were up 10.5%. So the company is producing more profits on a year-over-year basis. Now, looking at the balance sheet, Costco spent some money. They're down $50 million in cash. So they actually ended the quarter with less cash and short-term investments than they started with. Costco does this to do CapEx spending. They open up new warehouses. They do it to pay a dividend, and they also pay down some debt. So Costco paid down a little less than $200 million in long-term debt, which is something that I like to see this company do. I realize that they could pay a special dividend, they could return it in buybacks, but I want Costco to always operate as an unlevered business. I don't want this company to carry more long-term debt than they have in cash. So overall, I'm very happy with Costco's quarterly report. Very satisfied with it. The company is growing its membership base at a very high rate. It's growing its revenue at a very high rate. It's growing faster than a lot of tech companies that are the so-called growth companies. So Costco kind of plays two roles. This is a growth company. It is growing rapidly. The results show that. But it's also a defensive company. It holds up well during recessions. It's a very defensive business model. And it's also a subscription company, which is my favorite overall business model. So Costco kind of checks all the boxes that I look for as an investor. A fast-growing, highly profitable, free cash flow generative company that's very defensive as well. There's really not many companies like it in the market. Now moving on, we have some positive and kind of negative economic news at the same time. That's the environment that we're in. Sometimes good news is bad news, and sometimes bad news is good news. Consumers are running low on money, and that's good and bad news. It's bad news that consumers are running out of money and they're drawing into their savings, but the good news is if consumers run out of money, that means that they can't drive up inflation at as high of a rate, meaning the Fed would have to increase interest rates to a lesser extent. So again, good news is bad news is kind of good news. The Fed's favorite inflation metric rose 4.9% in April, a sign that price increases could be slowing. Apparently, this is the Fed's preferred inflation gauge. They say that it rose 4.9% in April from a year ago. Still an elevated level, but nonetheless, it indicated that price pressures could be easing a bit. That increase in core personal consumption expenditures was in line with expectations and reflected a slowing pace from 5.2% reported in March. So basically in March, the core personal consumption expenditures index, that's a mouthful, it was 5.2% in March, and then in April it was 4.9%. So it's coming down ever so slightly, and that is good news for the Fed. Now they say that consumers are remaining undaunted by inflation last month, strongly increasing spending and changing their mix to more services such as bars and restaurants and travel and recreation as the weather warms. But here's the key part. They say that spending was fueled in part by higher wages and also by Americans drawing more out of savings, which is a giant stockpile of at least $2 trillion. So now consumers are actually starting to draw into their savings. They're not spending just by wage increases, and that's an important thing for the Fed to look at. The Wall Street Journal reported further on this, saying that, quote, "We have finally reached the point where households are dipping into their $4 trillion of excess savings." So a lot of people saying that no people have savings right now, that's just incorrect. A lot of established households that have six-figure jobs have excess savings. The money they received in 2020, the COVID relief, was not necessary for a lot of households that received it. And for those people, a group of Americans, they received excess savings in the form of stimulus in addition to keeping their job and not being able to spend that money because they were stuck at home. So a lot of people have a lot of excess savings that's now finally starting to be spent. If you put this into two different buckets, lower income Americans and higher income Americans, the inflation issue is hitting lower income Americans a lot harder. Quote, "With inflation particularly hitting food and gasoline, lower income consumers are pretty much done with discretionary spending from their savings." So lower income Americans are feeling the squeeze of inflation through gas and grocery, and they're done spending. They're done spending their discretionary income. But we have the other group of people, the higher income group. Higher income consumers are likely healthy enough to continue funding their spending through savings for a while. Quote, "Excess savings are pretty significant. People kept it in cash and bank accounts. We've had a huge drawdown in the markets, but people's cash values are still above where they were pre-pandemic." So basically, you could put this into two buckets. We have the higher income earners, we have the lower income earners. Lower income earners, as of right now, are basically done with discretionary spending. They've spent through all of their savings, stimulus included. Then we have the higher income Americans that really probably didn't need as much stimulus to begin with, because they still have that in their bank account. They have a lot of discretionary savings to continue spending. So inflation will probably still remain somewhat elevated until the higher income Americans spend through that discretionary income. But again, my view is kind of contrarian on this subject. Most of the people that I talk to think that inflation is totally out of control, and it's going to spiral further out of control by the end of this year. I'm still in the viewpoint. I still maintain the same viewpoint that I think there's a very good chance inflation will be lower by the end of 2022 than at its peak. I think it will be much lower. So that's my viewpoint, but I'm investing where either outcome could happen, and I still think I'll have decent returns. Inflation or not, I'm investing in good companies that I think will weather this storm. So that's all for this episode. I hope you enjoyed it. Have a great weekend, and I'll see you in the next one.